Think about it. Millions of Filipinos suddenly out of work, billions of dollars in the economy wiped out, and an industry that has defined a generation hanging by a thread. Would this mean disaster for the Philippines? Or could it actually open the door to something bigger? Today we're breaking down what would really happen if America stopped outsourcing call center jobs to the Philippines. Let's rewind to the early 2000s. The United States was looking for a way to cut costs without cutting quality. American companies, from banks to airlines to tech firms, were drowning in customer service expenses. That's where the Philippines entered the picture. At first, the big player in outsourcing was India, with its massive English-speaking workforce. But the Philippines had something India didn't: a unique blend of language skills, cultural familiarity, and people-oriented service. Think about it: language fluency. The Philippines ranks consistently among the top countries in English proficiency in Asia. Many Filipinos speak with a neutral accent, making it easy for American customers to understand them without frustration. Cultural alignment. From Hollywood movies to NBA basketball, from McDonald's to Netflix, American culture isn't just imported to the Philippines, it's part of everyday life. Cost savings. A Filipino call center worker might earn 1/5 or even 1/10 of what a US-based worker makes. For companies, this meant saving millions while still delivering 24/7 support. Work ethic and adaptability. Filipinos are known for patience, politeness, and empathy, qualities essential for handling frustrated customers. Soon, multinational giants like AT&T, JP Morgan, Citibank, American Express, and Verizon began setting up operations in Manila, Cebu, and Davao. By the mid-2010s, the Philippines had officially overtaken India as the call center capital of the world. And this wasn't just about jobs, it was about transformation. The industry created a new middle class. Young Filipinos fresh out of college, who might have once worked in traditional local jobs, suddenly had access to global salaries, modern office spaces, and career growth. Shopping malls stayed open 24/7, coffee shops thrived, and condo developments boomed, all thanks to outsourcing. Now imagine this engine of growth suddenly losing its fuel. If the United States decided to stop outsourcing to the Philippines, the immediate consequences would be devastating. Here's how it would play out. 1. Massive job losses. Over 1.5 million workers are directly employed in the BPO sector, and millions more benefit indirectly. Overnight, at least 1 million Filipinos could be out of work. That's not just numbers. That's parents losing income, breadwinners losing stability, and young graduates with nowhere to go. 2. Economic fallout. The BPO sector contributes around 8–10% of the Philippines' GDP. Losing U.S. contracts could strip away up to $15 billion in annual revenue. That's equivalent to slashing a huge chunk of the economy in one blow. 3. Ripple effect on daily life. Real estate, office towers, and condos built specifically for BPO workers would sit empty. Retail. Fast food chains, cafes, and 24-hour convenience stores that thrive on night shift workers would see sales collapse. Transport. Taxis, buses, and ride-hailing apps would lose a major customer base. Education. Parents might pull their kids out of private schools and universities. 4. Urban centers in crisis. Cities like Manila, Cebu, Clark, and Davao that built entire economies around outsourcing would feel the hardest hit. These are cities that never sleep because call centers run 24/7. Suddenly, that nightlife and activity would vanish. 5. Social impact. Beyond the economy, it's about identity. The outsourcing industry gave young Filipinos prestige and global exposure. Losing it could cause frustration, brain drain, and even higher migration rates as people look for work abroad. At first glance, it might sound like a win for America. Bring the jobs back home. Keep American companies hiring American workers. But the reality is a lot more complicated. Here's what the United States would face if it stopped outsourcing call center jobs to the Philippines. 1. Skyrocketing labor costs. In the Philippines, a call center agent earns around $400, $600 per month. In the United States, the same role could cost $3,000, $4,000 per month. That's nearly 10 times more expensive. For a Fortune 500 company handling millions of customer service calls each year, the cost difference adds up to billions of dollars. 2. Higher prices for consumers. If companies are forced to absorb higher labor costs, they'll pass them on to customers. That means airline tickets get more expensive, bank fees rise, Your internet bill, your insurance premium, even your credit card fees all could go up. 3. Labor shortage in the U.S. Let's be real. Customer service jobs are stressful. Night shifts, angry callers, constant pressure to meet performance metrics. Many American workers simply don't want these jobs. Even if companies tried to hire locally, they'd struggle to fill seats. This could mean longer wait times, worse customer service, and declining customer satisfaction. 4. Impact on small and medium businesses. Outsourcing isn't just for big corporations. Many small U.S. businesses also rely on affordable call centers in the Philippines to manage customer support, sales, and technical help. If outsourcing disappears, small businesses could be the first to collapse, unable to compete with larger rivals that can still absorb higher costs. 5. Reduced global competitiveness. Remember, outsourcing isn't unique to the U.S. Australia, the U.K., Canada, and other countries use the Philippines too. If the U.S. pulls out while others continue, American companies may find themselves at a global disadvantage. Imagine 2 airlines, one American, one European. The European airline still enjoys cheaper Filipino support staff, while the American airline has to pay 10 times more for the same work. Who do you think offers cheaper tickets and better profits? Not the American one. But here's the silver lining. Losing U.S. outsourcing could force the Philippines to evolve. Instead of just answering calls, the country could move up the value chain into IT and software development, healthcare information management, financial and legal outsourcing, cloud services, and AI system support. Some experts believe the Philippines could transform from the call center capital into the digital workforce hub of the world. Already, many BPO workers are being retrained in data analytics, cybersecurity, and artificial intelligence. The seeds of transformation are already there. But let's not ignore the elephant in the room, AI. Even if the U.S. stays, automation is reshaping the industry. Chatbots, voice assistants, and self-service apps are taking over tasks once handled by human agents. Does that mean doom for Filipino workers? Not necessarily. Filipinos could shift from answering calls to training, managing, and designing AI systems. Instead of competing with automation, they could work alongside it, turning a threat into an opportunity. And remember, the U.S. isn't the only client. The UK, Australia, Canada, and even Asian markets depend on Filipino outsourcing. So even if America cuts ties, the Philippines could diversify its client base and strengthen partnerships with other economies. Painful? Yes. The end? Not at all. At the heart of this story is not corporations or governments. It's the everyday Filipino worker. For over 2 decades, call center jobs have been the backbone of the modern Filipino middle class. These jobs pay for tuition fees for children studying in private schools or universities, mortgages and rents for families living in booming cities like Manila, Cebu, and Davao, daily essentials like groceries, medical care, and even the occasional family trip. The outsourcing industry has raised millions of families out of poverty and allowed many young people to dream bigger. But if the U.S. suddenly cut outsourcing, here's what it would mean for the average Filipino household. 1. Financial strain at home. Breadwinners earning stable salaries would lose their income. Families might have to sell homes, move back in with relatives, or downgrade drastically. 2. Education interrupted. Many call center workers proudly send their kids to good schools and universities. A sudden job loss could force parents to pull their children out, delaying or ending dreams of higher education. But here's the flip side. Filipinos are incredibly resilient. History shows that when challenges hit, Filipinos adapt. In fact, this crisis could spark a wave of innovation and independence. Freelancing boom platforms like Upwork, Fiverr, and direct contracts with foreign companies are already helping thousands of Filipinos earn dollars without being tied to outsourcing firms. Digital nomad culture. With strong English skills and global competitiveness, many Filipinos could work remotely for clients in the US, Europe, and Asia, not as employees in call centers, but as independent professionals. Local startups. Imagine ex-call center agents pooling their skills to create Filipino-owned outsourcing firms or even launching businesses in tech, e-commerce, and online education. Outsourcing built the Philippines' middle class, but it doesn't have to define its future. The question is, when that day comes, will the Philippines be ready to rise above the challenge? Thanks for watching. If you found this video insightful, hit like, subscribe, and let us know in the comments. Do you think the Philippines can survive without U.S. outsourcing? Or is it too dependent? Let's talk about it.